fellow panelists. Thank you, Reality Plus, for having all of us over. It's a very interesting subject, alternative real estate debt, uh, risk and perspective. Before I start the panel, and we have a very eminent panel and I'm looking forward to their viewpoints on this. Um I just want to give a little background, saying, look, back then in 2005, which is where you start looking at what's happening at real estate, the banking or the lending was all done through traditional banks, private sector banks and public sector banks. Public sector banks held the most amount of loans, the likes of SBI, Union Bank, Bank of Baroda, etc. Then came in private equity in 2005. It fast tracked construction activity in India. Lots and lots of new projects were announced, uh, all different kinds of projects. And I guess it complicated life for PSU banks. They couldn't understand. And by 2012, they started to shy away from Indian real estate, and as because they couldn't underwrite the risk, they couldn't underwrite the time. RBI was coming down heavily on them, so the whole music slowly started to shift towards NBFCs. And for the next 7-8 years, it was the NBFC era. It continued till 2008, 18. When we look back, almost two-thirds of all loans extended to Indian real estate were by NBFCs till the music stopped when the ILFS crisis started in 2018. After that, it became extremely difficult for NBFCs to raise money, and therefore, consequently, they couldn't do onward lending. And my view is that has triggered the era for AIFs. So from 2018 to now, there have been over 60 AIFs. A lot of AIFs were set last year to take advantage of this situation, and leading to what we would classify as alternate debt that they're taking up, right? Uh, Anyways, as I mentioned, the market on the lending side was shrinking. We already are reeling under acute shortage on housing. We have a lot of mile to cover if we have to provide housing for all by 2030. I know the interim target was 2020, but 2030 is a realistic target. 25 million dwelling home units we have to build by then, and most of this is at the bottom of the pyramid, which is affordable and real affordable sector. Now, real lenders, PSUs, who have the largest pie of deposits, are still shying away. Then there's private sector, then there's NBFC, which has no money. So I'm going to straight come to a point, and I'm going to start with Ritesh. Ritesh, with wafer thin margins, highest volumes, how and what way this alternative debt is going to solve the problem for construction finance for affordable housing, right? You can't charge 18, 19, 20%, which is what the current clearing rates are for debt for real estate. How does that work? Ritesh, over to you.
Thanks, Shobit. Morning, everyone. So, Shobit, hopefully you've given me the answer to the question in the question itself. My short answer to you is that I don't think alternative debt is the solution for the kind of housing that we're talking about over here. See, of the 25 million homes that you spoke about just now, over 90% would fall under the category of what we call social housing, which is, we're talking about homes which are 5 lakhs, 7 lakhs, certainly sub 10 lakhs in terms of in pricing. This kind of housing, in any case has to have, and it does have infrastructure status. And, it can't be made possible, certainly in most of urban India, without some kind of government support. So my sense is, alternative debt, which is priced at a certain level, which is looking at a certain risk profile, is not like the most suitable capital solution for this. It's also, Shobit, you would agree that there aren't too many bankable developers who are actually active in this segment. And again, that's for a reason. You buy land commercially, you try and develop it for social housing. It's simply not possible. The numbers don't work. There has to be some kind of government incentive, a scheme, some land, some grants, etc., for the numbers to work. So my sense is, this is not a segment where alternative debt can come in. This is a segment where,
social,
fairly long-term, low-risk kind of debt can come in, because, this is something where you literally have no sales risk. If we can build houses in Bombay reasonably located at 10 lakhs, 12 lakhs, they'll get sold out, right? You'll have to do a lottery to sell. No sales risk. But there is a lot of execution risk in terms of getting your pricing right and so on. So I think I would repeat, alternative debt, not for this, but probably for the segment above this. If you're talking about the lower mid-market kind of housing, we're talking about, homes which are, let's say, between 15, 20 lakhs to going up to 30, 35 lakhs. There, I think, there's been enough activity already. Where you're talking about commercial developers, commercial projects. By commercial, I mean for-profit projects. Alternative debt has a role to play over there for sure. On the social affordable housing, I think what is probably needed is maybe more equity type investments and setting up platforms with larger developers who can then demonstrate that credibility for the government to support such projects, and for people to sort of participate actively in terms of developing such kind of product. That would be my view.
Thanks, Ritesh. But just challenging you on that a little bit, saying if debt can't be afforded by this segment, how will equity come in? Equity is typically the most expensive form of finance, and how will equity go into affordable, and therefore the bottom of the pyramid? I'd love to hear your views on this.
Sure. So, by equity, what I mean is, really longer-term capital, which will, like I said, right, this is a relatively low-risk proposition in terms of development activity and sales activity, providing you've got your numbers right. I think if there is a credible equity player, there is a credible development partner, you have the ability to go out, seek, the right sort of set of incentives from any local government, state government, and go on and build this product. This is also a product where you really need to be able to demonstrate execution because volumes are high. Your customer will not have the patience, to wait an extra 1-2 years for delivery. So I think, and maybe, Shobit, just to backtrack a little bit, maybe it's not pure equity. Maybe we're talking about
equity,
impact funds. Maybe we're talking about those kind of, sources of capital, which can come and take a longer term view. I think it can be made profitable for equity. Yeah. Because there is value in this space, but I think it's a longer term game. It cannot sustain on debt at 18% or 17%.
So yeah, you're saying there are margins, but you have to play scale. You have to take government support and government intervention, and maybe perhaps the impact funds are the right target audience. I'm going to bring in Chetan at this point. I mean, you have done a lot of debt. You guys were the first to do NCDs and debentures way back in 2008, I suppose, or 8 or 9. And you guys have been innovating structures for lending in real estate. So what's the newest? What are you guys up to? How you are playing this market between senior secured, last mile, and yet being able to deploy successfully? What's the mantra, risk versus returns?
Sure. Yeah, thanks, Shobit. So I'll just, give a brief background about what Kotak has been looking at from a RE fund business perspective. So we started our business somewhere in 2005-06 when the FDI opened up, and till date, I think we have raised about $2.2 billion over 10 different funds. In February, we raised another fund with a $380 million corpus where we are looking at investing in credit strategies across all the real estate classes. See, I think the idea is where these investors come from is more from the fact that as a fund manager, they are looking at one is what is your specific strategy of deployment in terms of the asset class, in terms of the stage of investment, in terms of the returns targeting, and most importantly, in terms of how are you planning the exit. A lot of these fund managers are having strategies around deployment opportunities, but they are not able to convince investors across this life cycle of the investment, holding the investment as well as the exit, which is a crucial part of any deal returns. So these investors, the way they are looking at us in specific is because given the experience across these years as well as the strategies across all the asset classes. So we will have a pool of assets or pool of funds available for deployment in equity, in debt, in commercial, in residential, in retail. So we are, if you ask me today, we are catering across all the asset classes through different strategies of funds. So each of the investor who is coming in is very clear where my money is going and what is the kind of return I should be expecting. Having said that, I'll take Ritesh's view also that we have also had investors who are, impact investors and want to invest specifically in an affordable housing asset class. So we have a fund catering to that also. So it is always better to have specific strategy focused funds rather than just one pool of capital which is going everywhere, be it debt or equity or different asset classes. So strategy specific is one key word or the key mantra which I would say. Other is also, if you look at the kind of opportunities which are there in the coming years, right? I read somewhere that Oxford Economics is saying that the INR depreciation, which is a key factor for all these global institutional investors, is targeting the INR dollar is targeted to be around 74-75 levels till 2030. So there is not too much of depreciation expected in INR. So that is another key factor when an investor is looking at is, apart from the opportunity and the returns per se, is my value of the dollar getting impacted when I exit or not. So that's something which will also give confidence in the next 2-3 years is what we see. So these kind of things is somewhere we have to focus on. Shobhi, just to cut the long story short, is somewhere have a specific strategy-driven investment focus, as well as looking at what the investor is also needed. For example, if you see, just taking up one step forward here, we also have a different type of investor catering to managed accounts. So we say that if there is a single investor who wants to put a large sum of money, we'll have a single pool of capital and we'll manage that. So where the investor will also participate in a decision-making process remotely in terms of saying that this is the strategy, this is the kind of investment we are looking at. And the managed account also works well for us.
So Karthik, if I have to, Chetan, if I have to sum this up, you are saying that you have different pools of capital for different asset classes within real estate and catering to very different risk return profiles. So all the strategy is very different to Resi and so on and so forth. And that's how you are able to manage and deploy sufficient money. Talking about offices, just moving on from Resi to office, Amit, can I bring you in on this? I think it's widely known that in the office sector, in the near and short term, there seems to be some risk owing to work from home, work near home, and new concepts that are emerging. But if India has to grow at even 5% or 6%, growth in office sector is inevitable. So long term seems like it is intact. But how do you think this is going to impact fundraising, especially debt, for commercial real estate? I'm assuming you are the best in this group to talk about offices.
Wonderful. Now, thank you, Shobit, Sapna, Realty Plus, Business World, and good morning, everyone. Shobit, my response on this is going to be from a combination of my experiences in various roles in the real estate sector. So, as a management consultant, I was advising, Temasek on their investments in Capital and Maple Tree Capital Corporation. So, I've seen those companies borrowing in Singapore for real estate. And then at GE, I was a lender in Singapore for real estate. At Piramal, I was a lender in India. And now at Heinz, I've been a borrower for the last 6 years. So I've seen both sides and in multiple geographies. And let me just start off by saying there are no new challenges. Shobit, capital is always available. The requirements of the lenders have been exactly the same since time immemorial. You need a logical project and business plan. You need a high quality operator that you can trust, and you need to have confidence on the execution. You've got those three places, three things in place. Money is always available. Now, from time to time, there will be slight new differences. And if anything, I think the challenges are actually fewer today because the lenders are flushed with liquidity at the lowest ever interest rates that I have seen in my time. So, there is capital ready and available, but the borrowers and the lenders have a very interesting dynamic. Both need each other a lot. Obviously the borrowers need capital to get financial closure, but the lenders are always looking for good quality opportunities to put their money and deploy the money. I think, as you rightly said, the office sector is in the middle of a shake-up, and this will continue, I think, for an extended period of time, multiple years is my sense. And I completely agree, long-term, the strength of the economy, the growth will take over. But one thing that will happen in these 2 or 3 years is a unquestionable flight to quality. So the occupier who's ultimately driving the value in the office sector is going to choose better partners, better landlords, and better projects. And as a result, the developers who are kind of manufacturing or owning, or the capital that is owning better projects, will get funding more easily. But yes, in the interim, next couple of years, as long as the uncertainty prevails, liquidity will be available more for lower risk situations. And that lower risk is a perception of the lender themselves, what risk they want to take and what they don't want.
Thanks, Amit. But I want to ask on this note, when you're saying lowering the risk as a perception, would you say doing DMs with firms like yourselves for office developers, does the perception have an impact on the lending side? Because the lender continues to be the current developer. However, you're managing his project, you're doing the right things, right? So you come in as an expert on the asset. Does it lower the risk? Does it become more bankable?
Yeah, I certainly hope so. Experience so far has been very positive. Okay. Most of the DMs, if you see, we've done with credible counterparties, but who are also facing increased competition from institutional owners of product today and very high quality pan-India, well-funded, internationally funded developers. So the competition has definitely become stiffer in the marketplace. And what we're trying to do is contribute the 2 cents that we know, which is more on the operating side. Risk is generated, obviously, bad location or a incorrect concept or bad contracting, incorrect financial closure, monthly, cash balances, and then, not having network with the tenants or credibility with the tenants. And, there are some of these parts where we can add value. And, so far we've been blessed, lenders have looked at us quite favorably. And I certainly hope that continues in future.
Thanks. So you are saying you are managing the risk as far as bankers are concerned. So it's to be viewed a little bit differently. It's not just about putting the Heinz brand, but basically what that brings in is the credibility for the lender, and therefore lowers the risk on the project.
Absolutely, Shobit. And let me add just 2 quick comments on that. In fact, Heinz does not add the brand. In the 1,700 projects that we've done around the world, there is no one Heinz tower. There is just, everything is neutrally branded. So the brand is not on offer, it's the expertise. But the second and more important thing is, lenders, when they were sometimes, in competition, were lending on the basis of, comfort from the parent group or the, guarantees. Uh, is it really enforceable? I think that's where the realization is. The money is going to come back from the project fundamentals. And what we are trying to do is help the project fundamentals, not really change the positioning or the naming of the borrower.
Super. So I'm going to take that language of profit is common everywhere. So you increase the profitability and therefore make it more bankable. Gaurav, I'm going to come to you. We've been living in troubled times, COVID-1, COVID-2. And most of my developer friends at this point are collectively looking to raise money. I see very few people who don't want to raise money, but they all have cash flow challenges, more in residential, but equally in office is becoming difficult to convince about leasability, when the lease is going to happen. Are the markets going to open in September this year or December next year? So all these questions, what according to you, and you're sitting in a very unique position, are some of the challenges that the developers are facing in raising this capital, and what's the workaround, if I may ask? How are you advising your clients?
Yeah, thanks a lot, Shobit, for having me on this panel as well, and to Business World. I think a couple of things here. Track record of the developer is very important. A number of investors, lenders have either put money as equity or debt, or banks have lent, and a number of them have burned their fingers quite badly. So when they look at any of the projects, I think it's the track record of the developer, and that how well has he executed on projects. And when you're bringing projects to a particular lender, I think the point is that what is the way you're going to go execute it, how you're going to make sure cash flows happen, what is your marketing strategy, how good are your completion strategies in the past and going forward, things like that, which show them a path to cash. Like Amit said, in the past people gave money based on parent guarantees, promoter guarantees, etc. But it's not that it has worked. We have so many cases which have landed up in IBC because the way the money has been circulated amongst projects, buying new land, not completing projects, has created a whole sense of discomfort. So when lenders now look at projects, they've learned a lot, so they want to be very clear that they're just lending to this project, and they may want to make sure that the cash flows are pretty visible, and how fast are they going to come out. I think developers have to get that house in order, and I think to that extent, what Amit said on you were saying also on DMs, and or some consultant, whoever can manage the project and manage the project cash flows, that becomes a very important factor. The second part is, I think a number of the distressed foreign funds who are looking at like distressed projects, they don't really have people on the ground, and although they have pools of capital dedicated to India. So when they are going back to IC, they are competing with various projects in the region. So the projects which they lend to in India have to give them that definite return, and therefore all this comes into perspective as to how good the project, how good the reputation of developer is. Otherwise, there can be a pretty significant challenge in lending or putting money in such projects. So I think these are the 2-3 things that we need to look at when we are going to look for more money from various funds.
So you're essentially saying that banks have moved away from name lending to really evaluating the projects on merit, looking at partnership risk, looking at execution risk, marketing risk, and then pricing it, rather than saying, okay, because I have corporate and personal guarantee, I don't really care about the project. I'll get the money from the corporate or from the personal. So I think that's changing. And clearly, I agree with you that that's kind of going away. You also spoke about hedge funds that are quite active on the distress side. And I'm going to go back to Ritesh. Ritesh, you've done a lot of last mile financing for stuck projects or stalled projects. And government has also set up an AIF in form of Swami. But that's quite straight-jacketed. There are 20 criteria, and you meet those 20 criteria, you qualify, and you can get that money reasonably priced. It's super senior, even in case of IBC. So there is a certain risk that has been removed. But for rest of the India, right, that risk remains. And by the own admission of, if Swami is to be believed, they are funding 1 in 10 proposals that they're getting. So what happens to other 9? How do they arrange money, and what's the risk return profile of these developers? How did you tackle it?
Like every market, right? There's a whole spectrum of developers. There's a whole spectrum of projects. There's a whole spectrum of risk that you're dealing with. There is a certain profile, a certain checklist that meets the requirement for, let's say, someone like Swami, and then there is a certain profile and a certain checklist that meets the requirement of the hedge funds or the distress funds that Gaurav just mentioned. So I think, and of course, Shobit, we all know there are a vast majority of projects that don't fit anywhere on this spectrum.
Yes, absolutely.
Right? Which are, these are like abandoned projects or orphaned projects, if I can use that terminology. The developer does not have the capability to finish. No lender has the confidence. The buyers have lost the confidence. And I'm largely talking about residential over here because that's, what the problem is largely. And I think any lender who's looking at coming into this space obviously needs to have a very clear-cut idea of what they're looking for and what risk versus return threshold are they sort of solving for. It should be obvious that a last mile financing should be lower risk because you're coming into a project with a fairly high degree of visibility. Probably it's half built, half sold. Usually the land approvals are in place, obviously, because it's already reached that last mile scenario. But Shobit, you'll be surprised that there are so many challenges that come in such projects as well. Forget about half built or last mile projects. We've seen it, and I can quote from personal experience of funding projects with occupancy certificates. Okay, now it can't get safer than that in terms of a textbook requirement. Projects with occupancy certificates can also face issues, and we are dealing with one such issue right now, where because what happens in these projects is there's a lot of history. So what was promised, what was delivered, landowner, developer, JDA, all kinds of things can sometimes open up when a new party sort of comes into the picture. So I would say to you, Shobit, there will be many projects which will not get funded. People will have to find solutions around it, and these solutions in India take their own time, more than anything else. Again, we've seen scenarios where projects which were totally non-fundable by any institution have been resolved by, existing lenders stepping up a little bit, finding someone else to come on and do the execution, just, infusing that confidence capital in the project to just get it going, where, existing buyers then start to support through cash flows. So I think it's a mixed bag. I don't think that every project which is in distress will get funded, and there will be many which will probably never get developed. And I think will just be a sad story.
So you are saying it's a little bit of an illusion in terms of approvals and sales and construction. And I'm going to bring in Chetan from Kotak. Quick question, like Amit mentioned that perhaps doing a DM in offices eliminates a few risks. He brings in the expertise, the solutions on the office. How necessary is it to change the developer to be able to fund some of these tough projects? Unlike Swami, which is saying, I will complete the project under the same brand and then sell it on completion. Will you do this, or have you done it? How critical is it for you that we bring in a new partner as DM?
So, Shobit, I think the crux of the matter, which Ritesh also touched, is when an incoming lender or investor is investing on a last mile or a stuck project, one thing I want to kind of highlight here is the kind of allowances. So every stuck project will have maybe an existing lender there, which may or may not be completely refinanced. So the idea here is the kind of protection which is available to Swami Fund today under the IBC and other statutes is not available to other alternate debt providers. So I think that is one crucial thing, which money is available for these stuck projects, but because of these limitations in the regulations, not many are able to deploy. Having said that, I think the opportunity is there. We have seen a lot of these. Our main source of deal flow is coming from these NBFC refinancing, where the pressure is to get out of stuck projects, where we can bring in some capital to give the existing lender and the balance to complete the project. Having said that, it is crucial today, like there are these DMs which are happening on the commercial side, similar kind of DM structure we are also evaluating on the residential side as well. Bring in our partner who has an established track record of execution and most importantly, sales. So there have been lot of these players in the market today, especially in Mumbai and these metro cities, who have been focused in rescuing or kind of taking up stuck projects. So here the developer in that sense who has been, not successful or has, created this kind of a mess, needs to sit back. He need not exit completely, but he needs to sit back and allow the incoming investor as well as the DM partner to complete the project. See, end of the day, all developers, they understand that they will not make any money going forward. It's more of their reputation being intact, that at least they completed the project and handed it over, is where they come from. And they are quite happy if there is capital provider plus somebody who's willing to execute and complete the project and deliver it, because there will be RERA implications, litigations, which will anyway be ongoing. So at least there will be some respite to the developers also from that aspect. So that's something we are actively involving and doing it.
Gaurav, I'll come to you on this. We've heard this, and I've been on the deal making side for long. If we have to bring in DM, which is clearly sort of, let's say 10% of the top line, give or take, if I have to generalize it, then you have GST, which is going to impact you. And then, of course, the last mile providers, solution capital, rescue financing, whether it's by hedges or by the likes of any AIFs, is, in my view, north of 15% clearly. How does this all sit together from your perspective, right? From tax, is there enough meat on the bone for all of these guys to be satisfied? Then the junior lender, then the developer behind, and there are so many vendors who've been unpaid. How does this whole story unfold? And what challenges do we have in doing DMs alone? I think it's easy to say, but it's very difficult to execute it from a tax perspective.
No, I agree. So, on the tax side, all this DM point, when you're talking about GST, I think one of the issues which comes up with commercial real estate, for example, is that the GST that you will pay the DM, you don't get the credit till you see. So that, adds that cost into the whole project, or into the, the project's costs and cash flows, etc. And I think many representations have been made to government that, this needs to change. It's been 3 years. I think we've been banging every door possible that, you're talking about GST, you need to have a complete, credit outflow. Otherwise, what's the point of introducing GST? So I think that's one point with challenge which remains. Tax rates, we can't say much because income tax rates have come down. So it's not that much of a challenge from that perspective. And, that anyway depends on sales. So if income tax will only come if there is income. But I think GST is definitely a blocker there. I think the other point, beyond just the DM, is also the rate of interest that we are asking for. If you're looking for so many things that to be absolutely clean, absolutely perfect, then you're basically getting to a situation that, you want equity type returns with debt, which is kind of difficult and makes it even, unviable really to service this amounts. So I think one solution or one point for that is that, we really have to look at a lowering of the rates, or at the rates at which money is coming into such projects. Otherwise, we will not really be able to do much with it. And also, I think when it comes to last mile funding or distressed projects, in some cases, the customers already paid 90% of the money. So really, what is this money chasing? It's just to complete the project. So where is the money going to come in? So maybe, government policy has to be there to say that, in these projects, we'll give you some additional FSI or an additional parcel of land, so that, there is some money being, made back by the lender or the equity provider to this sort of things.
And to add all of this, and I missed talking about is this withholding tax, because a lot of the hedge fund money is all dollar denominated. So not only do I pay interest, but they're saying interest net of withholding tax, which means I have another 15% markup. So really, it becomes extremely heavy. And I'm with you saying there may not be enough projects even to service that money, and then you need some support from the government. You spoke about equity. I'm going to go to Amit, saying, Amit, we are seeing a huge pressure. The people who can afford to delever, right, and listed companies are a representation of that. The top 10 listed developers have reduced their debt 27% in the last 1 year, right? They're getting debt averse, so they're bringing down their debt levels. People who want to borrow are not able to borrow, right? Is there a play for equity, right? When do you think equity funds are going to step up? Because we can keep talking about alternate debt, but we do need equity capital as well. And what's your view on that? I don't want to let go of this conversation without knowing where the equity is.
Couldn't resist, putting a couple of comments in on the previous dialogue between you and Gaurav. So here is my, weekend offer. If there is anybody who fulfills the criteria for our development projects, forget about 10 or 12%. We're ready to do DM at much more economical rates, 30 to 40% discount from the levels that you're talking about. So it really is not that expensive. But to Gaurav's point, and as you followed up on the withholding tax is a really big issue, and it is a huge issue, for equity. So that ties into my next one. The feasibility of projects in India are significantly drained, not only from the very high tax levels, but also the risk of tax cases opening up and scrutiny for completely ridiculous reasons. And thankfully we have the big four helping us on situations that come around from time to time, and they've got excellent understanding of this. But really, if one thing that I can request the government or the regulators is, with hands folded, a request that we keep our tax laws simple, business friendly, and just very transparent and straight and easy to do business. The short answer to your question on equity, yes, equity is 100% coming back, and equity's never stopped, Shobit. So the equity has been coming into different asset classes or different stages in the project. But even post 2000, 5 to 8, we all know there was a big gold rush in India. 2009 is probably the only time equity didn't come back. 10 onwards, you've seen equity coming back to acquire assets, i.e., there was no interest in taking buyouts. And equity since then has not stopped. It's come into different sectors, etc. So on the listed developers, firstly, I don't understand the rationale for listing. At least Heinz is a private developer, and we think that in an industry which is highly cyclical, has a long gestation period for each project, and is very transactional in nature, listing the pressures that you have from daily stock price changes and the quarterly reporting is pretty intense. But hats off to the developers who do it successfully. And the reason they do it successfully is they are able to counter and offer to their investors and analysts exactly what they are investing for. And is the developer really in the business of developing, or is the developer in the interest of a long-term hold of completed assets? I think that's where the difference of opinion is pretty strongly. So I believe that a lot of the debt reduction that's occurred is because of getting or passing on the completed assets to a long-term investor, as opposed to you as a development company, for which this is not the core business. And now that the balance sheet has been lightened and capital is freed up, I absolutely think that capital will get redeployed. It will get redeployed. I personally predict that there'll be a significant shift in the product mix in favor of the residential business in the next 5 years compared to office. And within the office, I think there will be many more private equity joint venture partnerships, because I don't think the developers and the listed developers essentially want to do it all alone using public money and have quarterly, reporting to do.
Thanks, Amit, for those strong and very convincing answers. I must say I endorse your views, so pretty much on the same boat. But I can't let this panel go without talking about one different subject. We have 5 minutes to go, and I thought I'll bring that up. We are talking about alternate debt. We've spoken a lot about what goes in and what can be done. What about alternate asset classes, right? I think you've spoken too much on resi and commercial, and somebody touched on retail. But let me start with you, Ritesh. You are looking at funding schools K-12, which is KG to 12. How real is that? And when you're buying these, how easy or difficult it is for you to raise debt on, let's say, operating school assets that you're buying? And I'll come to you after this, Chetan, on talking about BNC developers, because Gaurav and Ritesh both talked about partnership risk. So obviously, let's assume grade A will be taken care of. How do you handle grade B and C, which are catering to the lower end of the market on resi? So starting with you, Ritesh, and then moving to Chetan.
Thanks, Shobit, again. So I think, there is, as the market matures, and we've all been part of this market for a very long time now, there will be new asset classes, there will be new sectors which will open up as industry evolves, businesses evolve, the overall economy evolves, and so on. And we've seen that play out, right? It was earlier just resi, and then resi in office, and then retail came along. I'm not talking about hotels over here, because it's a totally different business altogether. And then we've seen, warehousing in the last few years. And similarly, we feel, there are going to be a few new sectors which will keep getting added up. And, we don't have to reinvent the wheel. You have to see what's happening in some of the other markets, US and Europe and so on, to see what kind of depth and scale they've been able to achieve, even within, let's say, alternative asset classes within real estate, which itself is an alternative, right? So my view is, all of these newer asset classes, whether it's education, whether it's data centers, whether it's warehousing, not anymore, I think, and a couple of other sectors as well. They have their issues. You're usually amongst the first few people going in. So, there are no set patterns. Who's the right player, who's not? I think you need to figure that out. The depth is not there. It's not like suddenly, you'll find, if it's student housing or it's co-living or it's K-12, that you will find, 50 deals to sort of choose from, because, it's just that much more nascent. So that brings its own risk, Shobit, obviously, because you need to see how it performs, you need to give it a few years, you need to figure out who the right people are. So I think the opportunity is there. It will take a few years to sort of figure out exactly what works and what doesn't. But I think, the fact is that it also throws up slightly differentiated returns, which then makes it sort of worth taking a calibrated risk on some of these newer asset classes.
Just a quick question, Ritesh. Are you getting LRD on school assets, which is rental discounting?
Yeah.
Is that happening?
Yeah.
Banks are stepping up to it?
Correct. So again, it's not so straightforward, right? If we had an office asset, or a warehousing asset, LRDs would be much more straightforward. Here, there is a element of working with the banks or the lenders to give them comfort around the key risks that they see, which is it's an operating asset. What happens if the operator sort of falls foul? What happens if enrollments don't come in? What happens if High Court, Supreme Court say that this year charge only 50% of the fees? How does the loan get serviced? So there are some of these issues which you have to deal with. But once again, I would say it's not like debt is not available. We've had reasonable success in talking to banks and securing the kind of financing that we need on reasonable terms, but slightly more hard work compared to, let's say, a straightforward asset.
Super. Thanks for that, Chetan. Quickly, we spoke about good quality developers, great partners, unwinding their positions in case they've got stuck. What happens to B and C grade that are catering to the lower segment, suburban markets of, let's say, big cities? How do you unwind that position?
So I think the the space we are in, we understand that the returns we chase, we are not gonna get all the deals from grade A developers only. We have to look at grade B, grade C. But our criteria of evaluating a partner is slightly different. What we look at is primarily the intent of the partner to be in this business. So we have seen in the last 4-5 years a lot of these new set of developers who have come in the business with a proper intent, proper processes and proper systems around it where they want to grow. So our target segment, if I would call that, is these people who have decent amount of business experience in this business and are capacitated and willing to go to the next level. So it's like those B or C grade developers who want to move to the A grade. So that's where we are looking at investing and growing along with them. We have strategies around partnering with developers for not just 1 or 2 projects. We look at their entire portfolio and see if we can partner with them across the portfolio. So that saves times for us, and also the understanding is very clear between us partners that what is expected from each other. We also clearly see the kind of adaptability the partner brings in. Is he willing to look at the kind of experience sharing we do? Because as an investor, we are not just financial investor. We also bring in a lot of our experience from the past projects as well as past development experiences in terms of how things went bad and what we can do to avoid today. So those kind of adaptability, if the partner shows, is where we are willing to partner with them. I think that is crucial, rather than just classifying them, saying that you are a downgrade developer, we will not fund you. We have to look at obviously the project economics first, project numbers stack up and all that, and secondly, the fire in the belly in terms of does he want to go to the level up.
So you're saying you look at the promising developers in the sports, in a sports term. You need not be 1, 2, and 3, but the most promising sports person. Great. Quickly, 2 last questions, one to Gaurav and one to Amit. Gaurav, what's your view on data centers, their growth, and how does that get funded? Because I think it's a hybrid between infra and real estate. So what are you seeing and what are you advising your clients on domestic funds being arranged for putting up these data centers? Because this is a new animal, 30-year leases. We are selling racks, we're not selling real estate. We are selling megawatts, we're not selling square foot. So what's the adaptability of banks on this?
So I think on the data centers, clearly, the pandemic has resulted in a huge increase in use of data. So clearly, you need the data centers to support such data use, whether it's for e-commerce or even for doing normal business, just like what we are doing today as a virtual conference. We're using as data. So data centers definitely pick up, and we've seen a number of platforms being set up to invest in data centers. So you have foreign capital providers who are setting up platforms for deploying money straight into data centers with local investment managers. So that's a trend we are seeing, and which I think going to continue in the near future for sure. That along with warehousing, I think is another sector where we see a lot of money deployed. And I would see the alternate debt or other funds also looking to put money into this sector. And I think we're quite bullish on this, and I think most of the capital providers also seem to be quite bullish on this.
Thank you. Last not the least, Amit, we're just in time for our session. I want to bring you in on co-shared economy, so it's co-living, co-working, and what's your view? Are you guys bullish in this sector? You're working across countries. What's the trends?
Yeah, I think the trend is very clear in my mind. Real estate is fast becoming a service rather than a product, and therefore, whether it's in the working space or the living space, I think there's great future. From an India perspective, it's very nascent. At least from my firm, we would like somebody else to make the early profits and show us also the early mistakes, and then we will follow.
So you want to be a follower, not the leader, on setting up co-living, co-working?
We absolutely don't mind starting later than others, and we're not in competition for speed or volume. It's high quality, lower risk.
Thank all my panelists. who are there. Just a quick summary is what I've understood is there is enough debt for the right risk and right reward. Equity is coming in. Alternatives are available both on asset class as well as debt. So, thumbs up. I think there are challenges around deal making, but well, that's market making. So it will take its own time. Thank you very much, all of you, for being on the panel, and